Welcome back to another episode of SoCal Multifamily Insights, where we give you actionable steps, insights to help you navigate the multifamily market and commercial real estate. I'm your host, Jack Patel, multifamily broker and investor here in Long Beach. And today we're going to tackle a question that's been a hot topic for everyone in multifamily and commercial real estate: insurance. Um, with me today, I have Zack
Iknadosian
from INF INF Insurance Services.
INM Insurance Services.
INM Insurance Services. So Zack works with multifamily investors, commercial investors, and helps everyone somehow get some insurance without breaking the bank.
Yes.
Right?
Thank you. Thank you for having me.
So Zack, thanks for being here. Before, what I like to do is I like to have you introduce yourself, kind of give us a background of what you do and how you got into your field, obviously insurance banking.
Okay. I started in insurance about 8 years ago. INM Insurance Services was actually started in 1987 by my dad, Ralph Iknadosian. So he's been doing it for over 40 years. My brother got into it 12 years ago, and I jumped in when I was 20. So it's been a good business, and just kind of needed a little bit of direction. And also it's cool to learn about all the different businesses and business owners. So that's kind of what drew me into it, and that's how I got into it and started getting licensed and selling insurance.
Nice. Okay. Kind of like most of us here in the brokerage field, or some family lineage. So, Zack, we all know right now, insurance is insane. It's tough. What's the current landscape?
It's tough. Yeah. Over the past, I'd say 3 to 5 years, it's really tightened up. A lot of insurance carriers have just started to pull out of California. Certain classes of business has just seen a lot of claims, and so these insurance markets are saying they don't want to write it anymore. And then when fires started happening about 10 years ago, they weren't so bad the first few years, but in the past 5 years, they've really picked up, and it's just causing a lot of insurance problems. And like I said, nobody wants to just stick around to write it anymore.
From that perspective, like a property owner owns a property for so long, no claims. But even then, where I'm seeing is, hey, Jack, I own this property for 20 years, never had an issue, never had a claim. Now underwriting's getting, my current carrier, their underwriter is getting tighter. They know the property. I've been with them for 20 years. What have you seen, like, why is the tightness of underwriting, other than all, I mean, I get it. There's always been all these claims and all that, but for properties that haven't had claims, why are they, or owners that haven't had claims or haven't had claims in the last 5 years, 10 years, why are they feeling the pain?
Basically, it just comes down to like that class of business, them experiencing, the insurance companies experiencing these high volumes of claims, and then the high payouts. Just makes them weary. And even if they've been on the policy for 20 years, over those 20 years, they don't always inspect the policy or the property. And so therefore, like, they get a little weary about these properties that have just been renewed, and they want to make sure that everything's being underwritten correctly, and they're collecting the proper premiums for these businesses. Because, I mean, up until about, I'd say 5 years ago, the premiums for a lot of these businesses and apartment buildings, property owners, they were just not collecting enough, because you're paying $3 to $5 grand a year in premiums, but they're paying out 20, 25, sometimes even the six figures in claims. And they're just not being able to make up what they are getting for premiums as they're paying out.
Wow. Kind of. So in retrospect, it's basically, even if you haven't had a claim, you're like guilty by association.
Pretty much.
Where everyone else that does a claim or something like that, if you're in the same business and that certain class of business, whether it be multifamily or whatever the case may be, you just have to pay the extra premium, since that class had a lot of claims for that insurance carrier or overall in the industry.
Yeah, I mean, the best way to explain it is for pretty much like 2005 to 2015, the insurance market was pretty stagnant. Premiums didn't really fluctuate too much. They were just about the status quo. Everybody was just renewing. But then claims started happening in 2015 when wildfires started going crazy. And then property losses, people were getting submitting claims, total losses. Now you're paying out sometimes up to $1 million for just one property. And that they can't stay afloat like that.
Right. I got you. Practical advice for some owners and investors: since premiums are going up, how can they mitigate or reduce their premiums for the current properties they own.
Mhm.
And let's say for someone that's buying a new property, maybe multifamily or even a commercial building, what should they look for? What should they, underwrite, or what should they do so they, when they go, the renewal comes up, it's nothing 40, 50, 60% increase.
Yeah. A lot of the things that these insurance companies want to see are updates, property updates to the HVAC, the electrical, plumbing, roofing. If you can show proof of updates within the past 20 years for all of those items, it usually will fit into a lot better of a market. Anything that's over 40 to 50 years old, really depending on the carrier, they're going to want to see updates. And so if you can provide updates, there's a lot more markets that'll take a look at it with a lot more competitive premiums.
When you say, what if someone has done a complete renovation of all the major systems in the last 5 years, probably 10 years? Will that premium be reduced lower compared to one that's been done 20 years?
Um, Yeah, I mean, I couldn't really give you a firm answer on that because they have guidelines saying that they want to see updates within the past 20 years. So it probably insurance companies would like to see them be done more recently because that means the property owners doing their job and keeping everything up to date and their due diligence. It just definitely opens up more markets the more recent you've had updates. So like a lot of these companies or policies are going into E&S markets, which is excess and surplus lines, non-admitted programs. Just because they're so old, the buildings are so old, and these carriers don't want to see old buildings unless they've gutted it and renovated it basically down to the studs. They don't want to touch it. So, like nationwide, they require updates, proof of updates, invoices from contractors within the past 20 years, and then they'll take a look at it.
Well, okay. Well, I have heard of that. What about someone looking to purchase a property? I mean, obviously, we help them as brokers, or myself, look at, because I talk to you and all, insurance brokers, what to look for when it comes to acquiring a new property, electrical, plumbing, how old is it? Because that becomes a concern. What advice would you give someone listening that's considering purchasing a multifamily property with or without a broker, or, just for their base knowledge, like, hey, these are the things you guys could look out for?
Go for a newer property. That's usually the best option, but just make sure that they have updates and all the electrical and roofing are probably the two top updates that they want to see, just because those ones are the biggest ones that will rise claims from. Just make sure those are up to date and that there's no leaks in the roof. Everything is kind of taken care of. They've been taking care of the building. But yeah, electrical, roofing, those are two options, and make sure that there's no cracks in the building, like on the walls and the pavement, stairs and everything. If there's a 2-story or all nice and paved, there's no cracks and no trip and fall hazards on there.
Right.
Painting's not chipping away from the roof or the roof lining. They want to see the property is well kept, and you that would be something to look out for. You don't want to buy something that's run down and it's just looks like it's going to be not nice to live in.
Not insurable.
Yeah.
Or a potential risk for the insurance company. Speaking of that, we're in Long Beach. Majority of these properties are almost 50, 60, even, almost 100 years old. A lot of owners I know here, they have these properties. Most they're getting the renewals done, or something comes up like, hey, we'll renew you, but fix this or that. Okay. But sometimes it comes up, hey, we're ready to sell. So we're ready to sell. We get in, we help them get into escrow, or we have a buyer that go into escrow, and we talk to the same company. Okay, this person's selling. Can we, this person wants to buy. Will you insure them? No. They'll renew, but they won't insure the next person.
Yeah.
So what actionable steps for 60, 70, 100-year-old property owners would you or even buyers advise, hey, here's what you should do if you're thinking of selling, if you're thinking of purchasing? Obviously, you gave us gave them some advice of what to look for, what to do, but mostly I think it's more on the owner. How can they mitigate some of this and have a successful sale or even a renewal?
When they're selling, it's just keeping everything up to date and making sure you want to make the property look the best it can, because that way you get the best dollar value for your property when you're selling. I mean, it's an interesting question for like sellers because I mean, sellers usually aren't too concerned with the insurance after the fact once they sell the property.
Um, we're having is when it's an older property. Like I was looking at some properties right now. I'm in a 1031 exchange, and the insurance quote. When we were talking about some of the properties I told you about. Hey, Jack, this is a concern. The electrical, it looks a little bit older. Hey, the
Yeah.
roof, like this and that. So sellers want to sell, but hey, those items need to be addressed before we can close, or there'll be no carrier. So a lot of them are thinking usually a price cut, or they usually need got to give a credit to get it done. When it comes to insurance companies, what would they give the seller a timeline, or not a seller? Will they give the buyer if they purchase it, knowing that they went in escrow, that these items need to be addressed? How long do they usually give for that person to the buyer to address these items?
Like for the insurance company based on the inspections?
Yeah, maybe let's say you look at I gave you a property, the electrical's old. You say, hey Jack, I look at the panel, it's a single panel. Okay, you got to change
Gotta
that.
change that.
Okay, Zach, I'll change that. I bought this property. How long will I have?
So if you know these things are already an issue prior, like or as you're purchasing it, once we put the policy in place, usually the inspection's done within 3 to 4 weeks of putting that policy in place.
Okay.
So once that inspection's complete, we usually get the report back another 2 weeks after that. And then they give you 30 days to complete or comply with the inspections. You have the 30 days to comply with them and then provide the completed recommendations. But they don't issue a notice of cancellation of the policy until you don't comply. So usually there's a little bit of more wiggle room. If I had to put a number on it, you probably have about 60 to 90 days from putting the policy into place to get all those items taken care of.
Okay. Well, that's good. That's good to know. Here's a thing I've heard lately. Before it wasn't a big thing, but I mean, I was hearing that from a lot of people. When you're as an owner, or investor, you're shopping for insurance. Before it was, hey, I need insurance. I go to 50 brokers or whatever the case may be, right? Hey, whoever brings me the best policy. Now I'm hearing, and insurance companies don't like this, where if you shop it too much, they won't take the property. Is that true, or like how would you ask that question? How would you answer that question? Is it better just to stick to one person or shop it around?
Me personally, I mean, I'm on the agent side. I would prefer them to stick with one person. If you want something remarketed, my agency usually does the remarket process every year on the policies. But a lot of these agents, they don't do that. They'll just let it auto renew. So you kind of have to force their hand and say, hey, I want this marketed. Can you provide other quotes? And I want to see what the others are looking like, rather than going to multiple different agents, because all of us agents out here, we have access to a lot of the same markets. And you can go to these companies, get appointed, and then you can write the same insurance with the same carrier, but through a different agent. I mean, you just got to ask the agent and kind of force them to really make sure they're remarketing it and have them provide you a second or third quote. So that way you at least know you're getting the best price, and you have a good company that's being insured, that's going to insure it.
You said something earlier regarding what was it? ES lines?
ENS lines?
ENS lines and admitted carriers. What's the difference between both?
Okay, so excess and surplus lines is usually the non-admitted carriers. Admitted and non-admitted are the two different carriers that we have in California. Admitted is basically just saying that they're backed by the insurance Department of Insurance in California. So if somehow that insurance company went belly up, the Department of Insurance would step in and help pay out those claims.
Okay.
Whereas if they're not admitted, they are not backed by the California Department of Insurance in California, so therefore they will not get any saving grace from California's Department of Insurance. The only thing is, though, is non-admitted programs don't have to file rates with California's Department of Insurance, so they can kind of make those or fluctuate rates a lot more. They can go down more, they can go up more. Whereas admitted carriers, they have to file that with the Department of Insurance. They have to get approval for these rate increases if they want to increase their premiums on the renewal. And Department of Insurance in California is sometimes a mess. It's a lot of a mess. Getting anything approved through there is tough.
Okay. Is it wise to go with admitted? I mean, obviously there's a backing, but does it benefit each way? Because I know you said you have both. You already in brokers have both quotes. Is it a good or bad to go either way, or
No, there's really not too much of a big difference. Just sometimes these non-admitted carriers through ENS lines, they're not as comprehensive of coverages.
Mm.
Like, whereas if you wrote it through like a nationwide Hartford Travelers, they have a business owner's policy form, which is more comprehensive. It covers all the little bells and whistles in there. So if there's any claim that you wouldn't really think about and that would arise, you would have it covered, and it would be insured by the insurance company.
you know, when full disclosure, Zach helps me with my property insurance. So when we were looking for property, like or insurance for my property, um, we admitted carriers won't even look at it.
No,
So I mean, most of them they won't even look at it. So we have to go. We have to go the
no.
non-admitted admitted route, and then so majority of the time it's you have to go that route. I mean, I know it sucks that they're not backed by the Department of California agents insurance agency, but we have no choice. Like, what kind of a who do they insure? Basically, let's put it that way, because I haven't seen a lot of properties that they will even look at.
Yeah, I mean, right now it's different, like operations, classes of business. Like, automotive industry is not really a hot topic. Like, if you do repair shops, they're insuring those. They will do like lesser's risk for commercial buildings. They like to see some of those, but those are also a lot of it just has to do with the age of buildings nowadays. Is like
Mm.
so many companies are tightening up on the age restriction. Like before, we used to be able to write policies with these admitted carriers or preferred carriers like Nationwide, Hartford, and Travelers, and the building age could be up to 1950s or all the way back to the 1950s, and you could just punch in the information, they'd spit back a quote, and you could place coverage. But up about 5 years ago is when everything kind of got flipped over, and in the past 2 to 3 years, it's really just gone a full ENS markets, and so everybody's struggling to write that.
See, I know. I mean, I'm in the same boat right now. Um, and then with that was this one question I had a client say, like, hey, my insurance, was like 4,000, and then for a multifamily property, then it went to like 6, then it went to 8, now it's at like 12, then now I'm getting renewal at like almost 18,000. He's like, there's no money to be made. I'd rather just self-insure. I was like, what if something happens to the building? But he's like, whatever. I mean, I can't afford it because I'm not
Mm.
making enough income on it. It's not worth holding the property. So well, either you have to sell it. He's like, well, I don't want to sell it. I like the location. So his answer to me was, well, I'm just gonna self-insure. And I was like, that's risky, right? I
Yeah,
mean,
that
something.
it's very risky to do. I mean, some people, if they're flush with cash and they have just money in the bank, I guess I understand it. But even then, we have some clients that are big value clients, high value clients, and they own a couple apartment buildings. They want everything to be insured, almost over insured, just in case something happens.
Mm.
They'd rather have full coverage just because it's the smarter thing to do. You pay some premiums on it, but God forbid anything happens, you have a total loss, the building just collapses. You want to be made whole again. You want to
Yeah.
be able to rebuild that structure and continue your business.
When it comes to that coverage, rebuilding structures, so um, when you give me quotes, and even other clients I've spoken to, these insurance underwriters kind of put, hey, the building, we could, you're over insuring it. I mean, you can rebuild that for $225 a square foot, $250 a square foot. And I'm sitting there, I'm like, in what world do you live in? Like,
Yeah.
like I mean, I just built an ADU and it was like $250 a square foot, and that's not including the land.
hmm
So where are you guys coming up with these numbers? And like, we have a formula. Well, how do you fight that?
Um, yeah, that's been definitely a topic because I mean, insurance, some clients they want to have a lower cost per square foot just to save money on the insurance, and then some of them they want to be insured to value and they want to make sure that they're made whole again. These companies have their own replacement costs estimators, and they're going based off of that. The best way I've seen to combat it is you just find a replacement cost estimator service of yourself. Like we have one through some of our carriers, and we punch in the information, get all the building details in there, square footage, year built, how many stories, and it'll spit back a replacement cost estimate. And usually those ones are pretty accurate, but that's if it differs from what they're asking and what we want to provide. That's what we've gone to our own replacement cost estimators.
Does your replacement cost estimator have, does it put in like government fees and red tape and stuff like that? Because right now to build a property back here, let's say in Long Beach, it's just not as easy. You have to go through a couple of hurdles. There's gonna be new building codes, new
Mhm.
ADA. There's a lot of stuff that has to be added. And from what I've seen, I don't think the estimators that the underwriters have kind of put that into their equation.
No, so those replacement cost estimators are strictly based on the structure, the value of the structure.
Right.
It doesn't include the building codes or getting it up to building codes. There are coverages for that, like ordinance and law or ordinance
Ordinance
and
and
law.
law. There you
Yeah,
go.
you can
Yeah.
get those coverages added onto your policies. They're not super expensive, but it gives you like 100 grand to keep all your properties up to code in case something does happen. If you need to rebuild it or something it partially falls down and you need to demo the rest and then rebuild it up to code as well, those coverages would step in.
Okay. Um, Looking ahead, we're almost midway. What today's August 8th, 2025. The next couple of years, where do you see the insurance market going? Is it going to keep doing this, is it going up, or do you see maybe we get some help somewhere?
Yeah, I mean, as of right now, I finally feel like it's actually starting to just stabilize a little bit. Premiums haven't been fluctuating as much as they have over the past couple of years. Like in 2023, I wrote an apartment building for 6 grand. Now it's going for 10 grand. And the past 24 and 25, it's stayed around that price. Haven't seen too many crazy increases. It's just also going to depend on what happens in California. If there's going to be some more crazy wildfires over the next couple of years,
Mm.
it's just so many unknown variables. And then as well as like what companies are going to be stepping in to write insurance. Like State Farm non-renewed 72,000 policies in the past year, and that's just in California. And so apartment buildings, homeowners, they when they pulled out, they're looking for coverages. They're paying 1,800 to 3,500 on these policies, and now they're getting a rude awakening with these ENS lines because nobody else wants to write it. And you kind of just got to wait for a new carrier, a new player in the game to step in and come up with a good program that's going to be competitive pricing, comprehensive coverage, and will hopefully stay in the game for a little bit.
Do you see more carriers or new carriers coming into the market, at least California market?
Yeah, there's been a couple of them that have come in and they've been pretty competitive. But the only thing is that when that market's coming in right now, there's so many people that need insurance. They're just getting flooded with insurance and submissions and quotes, and now they're binding policies and they reach capacity and they can't. At that point, they just pause and they have to stop writing new insurance. So it's just almost burning through insurance companies. One company steps in, they get filled up. Another company steps in, they get filled up. So
Wow.
hopefully it's starting to stabilize a little bit, but I think in another couple of years we'll see how it really pans out, and maybe we get another player in the game, and that will write some more policies.
Well, Zach, thanks for enlightening us with the insurance landscape here in California. If anyone watching wants to get a hold of you, where's the best place to get a hold of you?
You can go online to our website, www.inminsurance.com. That has all of our contact information on there. We have a little portal where you can submit your information as well, and I'll get an email with what kind of insurance you need. And then I'll reach out and get all the rest of the information on there.
Zach, appreciate it. Thank you for stopping by and enlightening all of us with some insurance.
Thank you, Jack.
Again, if you guys enjoyed this episode and would like to learn more about new ones, feel free to like, comment, and subscribe. That helps me bring more podcasts like this and more educational videos for you guys. And we'll see you on the next show.